Hello, everybody. How are you? My name is Mark. I am a former institutional trader, and yes, I have traded for hedge funds. I know people are so fascinated with hedge funds. They're not as really complicated as you think, but regardless, in my role as a head of trading at 3 different institutional money managers, I probably oversaw the trading of, I don't know, maybe 10 or 15 different hedge funds. I was also brought into the industry by Mario Gabelli, and I traded directly for Steve Cohen as well. So I traded directly for 2 of the greatest money managers in the history of the industry. So I've been around the block a few times, and just wanted to tell you why I think the S&P is going lower. As a matter of fact, here is my target, down around 32.30 now. You may ask, well, gee, why are you saying that? Well, there's 3 reasons, okay? One is that if we go back to 1929, there's been 25 bear markets. Bear market is defined as a market that drops more than 20% off its peak. The average bear market saw a decline of about 35%. So from the peak, where does that put us? Right around 32.23. The second reason is that in the financial markets, there's some levels that are more important than others. And 32.30 was an important level for the S&P 500. We can see here, it's kind of hard to see, but this was like the last level of support before the COVID crash. It became resistance here. Resistance converted into support, then it was support. So this happens because of seller's remorse, right? A lot of the people who sold here regret doing so after the market moved higher, and they tell themselves they want to buy their shares back, but they'll only do so if they can get them for the same price they sold them at. So they place their buy orders at the price they sold at, and if there's enough support forms like here. So this is a level that is important. The market has a memory, so there's a good chance there's support there again. So that's 2 reasons. Now the third reason is that if we get down to around here, the market will be in line with the historical valuation. In other words, the price earnings ratio, the price to sales ratio, so forth and so on, that is now above historical levels will get to historical levels. So those are my 3 reasons. An average bear market goes down about 35%. That puts us right there. It was an important level, and we're still overvalued. If we got down to this level, we would have pretty much right in line with the historical valuations. And we can even see here these lower peaks, right? When markets go in peaks and valleys, they don't go in straight lines. And when you have a peak that's below the former peak, we call this a lower high. Lower high, lower high. And this is bearish because it tells us that as time is passing, the sellers are becoming more aggressive. In other words, they're willing to accept lower prices. So that's it. Once again, please check out our website, stockmarketjobber.com. We talk a lot about many different things in the market. There's a lot of stuff on there that's not available here on the blog or on my YouTube page. So that's it, everybody. That's my reasons why I think the market is going lower. I hope I'm wrong, but we'll see. Time will tell. Thank you.